We are discussing the top stocks for 2022 in this video. We have studied hundreds of companies over the past month, and this is our list of stocks that we believe you should be keeping an eye on. But first, we'll review some recent major figures and explain why we anticipate longer-term growth for them. The best thing you can do is to remain up to speed on the news and just dollar cost average into the market, as the housing market has now entered what may be a short recession, with some analysts calling it a potential repetition of the 2008 recession. So let's get started. And don't forget to like, share, and subscribe for more updates. UMH. The first stock on the list is UMH Properties, stock ticker UMH. The UMH Properties is a public real estate investment trust with a portfolio of more than 20,000 developed home sites across 10 states in America. As you can see, one share of UMH is currently trading at $20.13, with a 52-week low of 16.50 cents and a 52-week high of 27.5 cents. So here, we have the one-year share price for UMH Properties. They have a market capitalization of $1.15 billion, a PE ratio of 100.65, which translates to very high earnings per share of 20 cents, and they pay a fantastic dividend of 3.75. When we look at their valuation metrics, we notice a price-sales ratio of 5.59 and a price-to-book ratio of 3.75. With revenues of $188.71 million over the past year, their profit margin is currently 21.45%, with return equity of 6.16%. Their balance sheet shows they have total cash of $292.46 million and a current ratio of 22.36. Is that correct? Okay, so UMH Properties recently closed a deal acquiring yet another manufactured home community in Erie, Michigan called Hidden Creek. Through the deal, UMH added another 351 developed home sites to its portfolio. These home sites take up nearly 90 acres and are over 60% occupied, so this recent acquisition, right now, we're rating it as a 1.7, meaning it's a buy. And the average analyst price target is 26.50 cents, which is just over 30% higher than the current price of 20.13 cents. Looking at who owns this right is another way to judge its legitimacy. It is reassuring for retail investors like us that most UMH shareholders are institutional investors, indicating that UMH has high credibility among the largest investors in the market. AXP. The first item we'll discuss today is the ticker symbol AXP for American Express. A share of AXP is currently trading at $157.28, with a 52-week low of 134.12 cents and a 52-week high of 199.55 cents. Amex is a worldwide firm, well recognized for its payment card services. If we look at the price history over the past year, we can see that we were trading around $170 per share a year ago. If you look at the valuation metrics, you can see that the 5-year expected PEG ratio is 1.33, the price-book ratio is 4.91, the current profit margin is 15.86%, and the return equity is 31.2, which is very strong. What experts are saying. A recent report revealed the change in credit card spending among American Express users, with rapid increases in spending for airlines, lodging, and restaurants. So on a scale of 1 to 5, with 1 being a strong buy and 5 being a sell, analysts are rating Amex as a 2.3, meaning it's a buy. The average analyst price target is 170.52 cents. The outcome is a consumer market that is eager to travel and spend money that is now one of the biggest this summer. Moreover, this is the first summer in years where the worldwide market isn't considerably hampered by potential outbreaks. Dollar Tree. So the next up we have is the Dollar Tree. One share of the Dollar Tree is currently trading at $166.29, with a 52-week low of 82.26 cents and a 52-week high of 177.19 cents. Looking at the one-year price chart, we can see that we were trading at just under 100 a share a year ago. Dollar Tree is one of the most well-known discount variety store chains in America and is a Fortune 500 company that operates over 15,000 stores throughout 48 US states as well as Canada. They have a market valuation of $37.133 billion, a PE ratio of 24.89, and earnings of $6.65 per share after a fairly quick rebound. They have a price-to-book ratio of 4.45 and a 5-year projected PEG ratio of 1.09. Although the profit margin is only 5.57%, the fantastic return on equity is 19.03%. The stock is currently classified as a 2.4, which means it is between a buy and a hold. The average analyst price goal is 175.47, which is roughly 6 to 7%, and this is based on revenues of $26.74 billion in the most recent 12 months. Inflation has been a concern for many retail firms, including Dollar Tree, which is more than the current price of 166.29 cents. Dollar Tree claims to be much more focused on exceeding customer expectations by providing high-quality products and services than before it recently increased the value of its items to $1.25. Given these higher prices, we should anticipate a slight decline in profitability and sales for the company in its first fiscal quarter of 2022. Netflix. Netflix is an entertainment and production company that has become synonymous with households worldwide. On the other hand, Netflix is credited with transforming the antiquated equation of physical media into the streaming empire we know today. Netflix has had enormous success in over 2 decades of operation, with around 222 million subscribers. Netflix has been one of the best stocks to invest in on Wall Street since it went public in 2002. The pandemic's tailwinds allowed Netflix to reach an all-time high of $700.99 in the fourth quarter of last year. Netflix, on the other hand, has only declined since then. A broader tech sell-off triggered the initial drop from all-time highs when the Federal Reserve announced that interest rates would be raised to combat inflation. Any company associated with its growth or technology suffered. Investors exchanged technology stocks for safe commodities with strong balance sheets. Netflix began selling off in stages through no fault of its own. Investors simply desired to exit the technology sector in an inflationary environment. However, Netflix's most recent quarterly report exacerbated concerns in the worst way possible. The most recent decline has brought Netflix's valuation down to earth, which may benefit investors. The streaming giant is fairly valued in comparison to its industry peers, which have a median PEG ratio of 1.61. Netflix is heavily investing in local content for a number of regions where it hopes to increase its subscriber base, including Europe, Middle East, Africa, Latin America, and the Asia Pacific. Netflix announced that it will try to limit account sharing in order to increase revenue in markets where their service is already oversaturated. Until recently, the streaming service ignored account sharing, claiming that the benefits outweigh the costs. However, it appears that their previous attitude toward shared accounts has shifted. If Netflix can use this new idea to gain new subscribers in already oversaturated markets, the previous guidance issue will be a passing blip. As a result, the latest sell-off will be nothing more than a buying opportunity for investors who act quickly. Apple Inc. Apple Inc. is the world's largest company, with a market capitalization of $2.3 trillion. Nonetheless, despite its status as a global leader in a variety of industries, Apple has not been immune to broader market sell-offs. Over the course of 2022, indiscriminate selling occurred, and Apple may not be the exception. With inflation raging and fears of a recession looming, Apple is down roughly 28% year to date. However, shares are down not because of anything the company has done or hasn't done, but rather because of the general negative sentiment on Wall Street. So far, in 2022, Apple appears to be underperforming. However, Apple's fundamentals appear to be stronger beneath the surface. Most notably, the recent share price decline has provided investors with an excellent opportunity to enter a position in one of the best stocks to buy and hold. For starters, Apple has performed better than the majority of other technology companies on the market. The company's product segment, which includes the iPhone, Mac, iPad, wearables, and other accessories, increased sales year over year and accounted for 80% of total revenue. Apple's service segment, which includes the App Store, Apple Music, Apple TV+, iCloud, and other subscription businesses, saw a 17.3% increase in sales year over year to nearly $20 billion. There's no denying that the company is firing on all cylinders at a time when others are struggling to stay afloat. Apple's optionality and revenue streams are growing almost exponentially. Once known solely for its desktop computers, Apple now provides best-in-class services and products across a wide range of industries. Moreover, Apple appears to be aware of its maturing business and is more than capable of doing what is necessary to remain relevant. Buy now, pay later is just one of the many levers Apple will pull in the coming years to position itself as one of the best stocks to buy right now. Let us know your views in the comments below.